Welcome to the Sand to Pirls Stock Market Commentary for market week ending Friday, November 28th, 2014. Market breadth. With this past week's market advance, our bull-bear point and figure ratio fell from 1.17 to 1.08, barely remaining in bullish territory. The total count of securities in bullish or bearish patterns rose 3%. to 2,598. The count of bearish stocks increased 8%, while the count of stocks in bullish patterns decreased 1%. The Sand to Pirls P&F Market Breadth Summary chart shows us a market now 5 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 73 points for the 5th decline in 6 weeks. At a positive 188.80 points, it has advanced past last week's intermediate top and continues below all 8 tops above plus 100 and above all 7 bottoms below minus 100 in the last 3 years. Market Gauge Volume Analysis. In this week's volume analysis, the Nasdaq 100 Trust ended in accumulation mode. In the last 2 weeks, it had 6 accumulation days and 2 distribution days. Of the other indexes, the Diamonds Trust ended in distribution mode, while the S&P 500 Deposit Receipts ended in neither accumulation nor distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq 100 Trust ended in neither accumulation nor distribution mode. Momentum. The CCI 20 Daily continues its Woody's uptrend and at plus 184.87 remains above plus 50, outside the range for a valid zero-line reject entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The CCI 20 Daily of the Nasdaq Composite Index began a Woody's uptrend 21 weeks ago, while the daily CCI 20 began a Woody's uptrend 4 weeks ago. At plus 163.62, the CCI 20 weekly is in a Woody's uptrend and remains outside the plus or minus 50 range for a valid zero-line reject. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish, S&P retail, and semis continue in the top 5. Networkers has entered the top 5. Oil services, oil, and gold and silver have entered the bottom 5. Brokers and banks have left the bottom 5. Bearish? None. Focus this week. We are entering a new oil normal from Jawad Mian of Outside the Box, posted by Tyler Durden at www.zerohedge.com. And some significant points from the article. We believe we are entering a, quote, new oil normal, end quote, where oil prices stay lower for longer. The reason oil prices started sliding in June can be explained by record growth in U.S. production, sputtering demand from Europe and China, and an unwind of the Middle East geopolitical risk premium. Our analysis leads us to conclude that the price of oil is unlikely to average $100 again for the remaining decade. We think the next 5 years will see a similar trading range develop in oil, with prices oscillating between $55 and $85. The consumer windfall from lower oil prices is more than offset by the loss to oil producers, in our view. It is still important to keep in mind, however, that most big oil projects have been planned around the notion that oil would stay above $100, which no longer seems likely. We believe a sustained drop in the price of oil will slow U.S. shale investment and production growth rates. This has happened once before. By the mid-1980s, as oil output from Alaska's North Slope and the North Sea came online, combined production of around 5 to 6 million barrels a day, OPEC set off a price war to compete for market share. As a result, the price of oil sank from around $40 to just under $10 a barrel by 1986. In the current cycle, though, prices will have to decline much further from current levels to curb new investment and discourage U.S. production of shale oil. The median North American shale development needs an oil price of $57 to break even today, compared to $70 last year, according to research firm IHS. So it can be grasped that the lower the price of oil falls, the greater the need for OPEC, etc., to compensate for lower revenues with higher production, which paradoxically pushes oil prices even lower. Those nations with abundant oil tend to suffer from the resource curse. With no other ready sources of income, the non-oil economy atrophies due to the extraordinary wealth produced by the oil sector. OPEC countries are some of the least diversified economies in the world. With global energy prices at multi-year lows, Russia is facing a persistent low-growth environment and an endemic outflow of capital. Quote, "It took 2 years for crumbling oil prices to bring the Soviet Union to its knees in the mid-1980s, and another 2 years of stagnation to break the Bolshevik Empire altogether," end quote, writes Ambrose Evans Pritchard in the Daily Telegraph. Today, Russia needs an oil price in excess of $100 a barrel to support the state and preserve its national security. We are convinced Putin would like to see a bull market in international tensions. This is the biggest threat to our New Oil Normal theme. This week's commentary, presented by Donald Pearl, www.s2pmarketsignal.com. Thank you for viewing this week's Sand to Pirls Stock Market Commentary, hoping that you've had a peaceful and pleasant holiday weekend, that you have a great week coming up, and wishing you true success.